Hi friends, no matter when you are watching this video is an extremely important video. Right now, officially we are in the market downtrend because Nifty has fallen almost by 10% at the time of recording this video. And it's not just Nifty 50, it's in fact mid-cap index. If you look at my screen, you will see has fallen by almost 10% in the last 4 to 6 weeks. If you look at the Nifty small cap 250 index, that has also fallen by almost 10% in the last 4 to 6 weeks. Nearly 500 equity mutual funds in the month of October has published negative returns. If you see this list on my screen, you will note that there are mutual funds that have given almost 11 to 12% negative returns just in the month of October 2024. I don't think we can easily forget the month of October 2024 when it comes to our portfolios. A lot of retail investors are right now panicking, seeing their mutual fund portfolios coming down. Some of them are blaming FI, some of them are blaming government, some of them are blaming their neighbors, no pun intended, but the point is that right now we are seeing mutual fund portfolios come down. And if as an investor you are not able to withstand this volatility, you have two options. Option number one is don't invest in equity mutual funds. FD is your best friend. The second option is to understand smart beta mutual funds or factor mutual funds to construct your portfolio based on the market cycles. That's why this video is really important. People who do not understand what are the smart beta mutual funds or factor mutual funds, let me take 1 minute to explain the basics and then we'll deep dive into one of the specific smart beta mutual funds, which is absolutely the key to understand in these market downtrend conditions. People who do not know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. If you want to learn about stock market mutual funds and many other assets, consider joining my YouTube member community. I post almost on a daily basis. The feedback of this community has been excellent. You are going to learn a lot. Therefore, go to my channel and press on join button. Also, you can find the link in the description or in the pinned comments. With that, let's get this video started. So point number one is, what are these smart beta mutual funds? What are these factor mutual funds? Some people also call them strategy mutual funds. So many names have been given by people to these mutual funds. So let me give you very simplistic 1 minute explanation of these mutual funds. So when you invest in an index mutual fund, simplest form of mutual fund investing, let's say you invest in Nifty 50 rupees and let's say you invest 100 rupees. Where does your money gets invested? Your money gets invested in the top 50 companies. When I say top 50 companies, I mean these are the biggest companies by their size, by their market capitalization. So for example, out of the 100 rupees, 12 rupees is going to go into HDFC Bank Limited because HDFC Bank has the highest free float market capitalization, followed by ICICI Bank that will have around 8 rupees, Reliance Industries 8 rupees. The point here is that when you are investing 100 rupees in Nifty 50, you are essentially investing in a mutual fund that has selected stocks based on the size, and traditionally people have been investing in mutual funds based on their size. Recently, technology has made it possible to try and dissect the data and ensure people can select the stocks in a particular index or in a mutual fund based on various factors. So for example, if you say that, Rahul, I want to only invest in those stocks that are trading at a lesser value than its intrinsic value, meaning that you are a value investor and you want to invest in a mutual fund that is giving you an option to pick up only those stocks that are driven by the value. Like this, there are broadly 5 parameters, as you can see on my screen, which is one factor could be value, second factor could be quality, third factor could be momentum, fourth factor could be low volatility, and fifth factor could be size. Now, if I explain all of these to you in one single video, then we are not going to learn much. But in this video, I really want to zoom into low volatility mutual funds because these are the mutual funds which are extremely important when markets are in the downtrend. Whenever you see market correction, whenever you see market crash, whenever you see 5 to 8% smaller correction, these low volatility mutual funds give you comfort, they give you peace. So let me explain to you what is volatility, how does it really help your portfolio, and more importantly, how to go about investing in mutual funds that are showing low volatility. So I'll give you very practical, simple examples. Have a look at my screen and you will see here a stock and you will see the price movement of this stock in the last 1 year between June 2023 and June 2024. Right? What you see here is the tall candles, very tall candles here during the day A in this particular screenshot. Now have a look at stock number 2. Here also you see the price movement of this stock between the same period, June 23 and June 24. And here you will note that these candles are not very tall on a specific day. So although both stocks have gone up in the last 1 year, but the fluctuations during the day in terms of the price has been very high compared to stock 2, which has been more stable, less fluctuating, and this is what is called volatility. Stock A is highly volatile as compared to stock B, which is less volatile. Now comes the natural question that, Rahul, why is that the lower volatility is always good? So have a look at this example here. You will see two mutual fund portfolio, mutual fund A, mutual fund B. Both mutual fund portfolios have given almost similar returns, 30% returns in 3 years time period. But what you see in portfolio A is that during these 3 years, the mutual fund portfolio has shown higher fluctuations. In a particular month, it might go down by, let's say, 8%, 7%. It might go up by 5%, 6%. While in case of mutual fund B, the portfolio goes up by, let's say, 2%, 3%. It comes down by 1%, maybe 1.5%, maybe 2%. So the fluctuation in mutual fund portfolio B is less as compared to mutual fund A, meaning that if you are an investor in mutual fund B, you are going to get better sleep. Because if you're checking your portfolio on a monthly basis, you're not going to get scared by seeing an 8% fall in mutual fund portfolio. While in case of mutual fund A, as soon as you see that your mutual fund portfolio is almost down by 8%, 9% in a given month, that is what is right now happening in the month of October, what you're likely to do, you might get scared away. You might really start losing sleep. You might say that mutual fund investing is not for me. Actually, what you've done is you've made a wrong choice of selecting the mutual fund. So I hope you understand why the volatility is such an important factor if you're a mutual fund investor. It gives you peace of mind, it gives you sound sleep, and makes your mutual fund journey much more comfortable than making it really a bumpy ride. So far, if you're liking this video, humble request you to hit the like button. Let me know in the comments a simple thank you. It motivates a lot to bring such content and topic for you at zero cost. With that, let's move to point number 3, which is a misconception that many people hold, that low volatility index or low volatility mutual funds give less return than the mainstream mutual funds. So let me try to debunk that myth. Have a look at my screen and you will see an index called Nifty Low Volatility 50 Index. What does this index actually do? In this index, we look at the top 300 companies by size, and out of those 300 companies, we select 50 companies based on the low volatility. So this index, if you compare the returns now with Nifty 50, you will note that this index on a long-term basis have very comfortably beaten Nifty 50. This is given 16.55 returns, and if you look at Nifty 50, it has only given 11.61 if I compare price returns. If you look at the 5 years, this index has managed to give 19.49% returns, while Nifty 50 has managed 15.95. If you look at even 1 year basis, 35.69% versus 26.64%. So all in all, this index has comfortably beaten Nifty 50 returns. Just so that I prove that I'm not cherry picking data here, also have a look at Nifty 100 Low Volatility 30 Index. Compare that with Nifty 100 Index and you will see that on a long-term basis, this index has given 18.35% returns, while Nifty 100 has managed 17.52. On a 5-year basis, this index has given 18.54% returns, while Nifty 100 has given 17.06%. So my point is very simple. Over a longer period of time, low volatility index does not mean low returns. It could give you better returns. It may not give you better returns. Returns is not the core central theme here. The core central theme here is the low volatility. And in the past, the returns have been really good. It's not that the returns have been bad. So why is that low volatility mutual funds are able to give better returns? For that, have a look at this screen. And this is an extremely important data point that during the bull run, if you see, for example, there are 5 to 6 bull run situations here given the time periods, and if you see, Nifty 100 Low Volatility 30 Index has not done great during the bull runs. In fact, it is able to capture part of this bull run. So for example, during the 2007 boom, Nifty 100 gave 64% returns, but Low Volatility Index managed to get 37% returns. But there are other instances as well. So for example, if you look at strong earning momentum between June 2022 to September 2024, Nifty 100 gave 28% returns, but Nifty 100 Low Volatility gave 32% returns. But all in all, if you look at these past history, we can say that yes, during the bull run, low volatility index do not perform exactly how the market is performing. But have a look at this screen here and you will see that whenever the market is under pressure, which is the case right now, whenever the market is correcting, thing. Whenever the market is crashing, then Nifty low volatility index, they do not fall at the same extent. So for example, if you see here, Eurozone crisis happened, minus 21% drawdown in Nifty 100, while volatility was only down by 9%. Again, you can have a look at these circumstances, situations, and you will conclude very easily that during the market crash, low volatility index are the best friend. Lastly, when the market is moving sideways as well, when you see low volatility index tend to do much better. Have a look at these data points here. Again, you will see that low volatility index has done much better than the normal mutual fund indexes. My point is very simple, that low volatility mutual funds generally during the market correction or the crashes fall lower than the overall market, and that is where they try to generate better returns. I hope this analysis, these data points tell you that low volatility does not mean low return. Actually, in the last 5 to 10 years, low volatility mutual funds have given better returns than the mainstream indexes. Moving on to point number 4, then Rahul, what are our options to invest in low volatility index mutual funds or active mutual funds? So you really have two main routes. Number 1 is the index mutual funds. Number 2 is the active mutual funds. So when I speak about the index mutual funds, you can simply go to tickertape.com, a free website. I use that for a lot of comparison for mutual funds, and I've spoken about this in a lot of my previous videos. But here you will see that I've got 4 index mutual funds that are tracking Nifty 100 low volatility 30 TRI index. You can go and compare them based on the AUM, for example. You can compare them with the expense ratio. Lower the expense ratio, of course, better it is. You can look at their CAGR, last 3 years returns. You can look at their absolute returns as well. But more importantly, in index mutual funds, one important factor is to look at the expense ratio, because you are anyways paying for managing your index mutual fund passively. So you really don't need to spend a lot of money. So one choice is to go down the index mutual fund route. By the way, none of these are recommendations here. I have simply shown you a method to go and find your index mutual funds on tickertape.com, a free website that you can use, right? Now coming back to the second route, which is active mutual funds. So there are active mutual funds who go and typically pick up the low volatility stocks in a mutual fund and give you that mutual fund to subscribe for. Now again, it's very hard to find such mutual funds, but what you can do is if you go to Google and type minimum variance mutual funds, you are likely to get active mutual funds that are including stocks that have minimum variance. Minimum variance means low volatility. It's a different name given to low volatility, which is minimum variance. So for example, here you can see on my screen, when I went and did Google on minimum variance, I got these 2 mutual funds. Again, none of these are recommendations. I'm just showing you how to go about finding active mutual funds which are low volatile in nature. These are called minimum variance mutual funds. Now, whether you want to go for active or index mutual funds, it is up to you entirely depending on your risk appetite. If you think that you want to go with an active mutual fund because active mutual fund manager might pick up better stocks, it's a choice that you can make. If you want to simply stick to the index mutual fund, again, that's your choice. I've given you both options. My intent here is to educate you people so that you take your options based on your own preference, based on your own risk appetite. Moving on to my last point, which is remaining smart beta mutual funds or factor mutual funds. So if you look at my screen, we have talked about the low volatility here. I have created a separate video on momentum mutual funds. Please go and watch that video. You're going to learn a lot. I've also covered value mutual fund in one of my videos, previous videos here. But please note that momentum and value, these two factors do not really perform when the market is in downtrend. It's a one-liner statement I am giving you. I have spoken about these in the previous past as well. Please understand that momentum and value do not really perform good when the markets are in downtrend. Right now we are in downtrend. I don't know how long will it last. I don't know when you're watching this video. So look at the prevailing market conditions, look at the market cycles, and based on that, you can decide whether you want to go with momentum or value investing. I've given you a lot of content in these 2 videos. Please go and watch these 2 videos. Now coming back to quality, typically quality is supposed to be an evergreen factor because here you are trying to pick up stocks based on the quality of the stock. For example, the earning growth of the stock. For example, the debt ratio, debt to equity ratio of that particular stock. So these are some of the parameters you will look at. Maybe at some point in time, I'll create a separate video on quality mutual fund because right now I think this video is getting really long. So maybe I'll have to create a dedicated video on quality mutual funds. Likewise, on size, there are various ways you can dissect stocks and pick up in the mutual fund. So for example, equal weight indexes in Nifty 50, rather than having free float market cap wise allocation, you might go for equal weight sort of a mutual fund. Again, there are a lot of permutation and combinations. It's extremely hard to cover everything everything in one single video. But in this video, I hope that you understood the concept of volatility. I hope you understand low volatility does not mean low return. And I hope you understood how to go about investing in low volatility mutual funds when the markets are down, they are correcting, or they are crashing. I hope you enjoyed this video. If you did, hit the like button. I'll see you in my next video. Until then, keep rocking.